All right, so here's Tuesday and Wednesday's opening range gap, and you probably remember that yesterday. And I like to keep opening range gaps on my chart for 3 days. Okay, so that's one of those opportunities. If you're not paying attention and you just let me say it and you don't write it down, it's one of those gems that just simply will not make it in your understanding. But after 3 days, it expires in my mind. Okay, and it's all part of my Power 3 concept, which I'll teach more about later. It's not just simply the open, high, low, and close, or the accumulation, manipulation, distribution. It's not just that. It's much more than AMD. Tuesday, Wednesday, opening range gap is shaded here. That's what we were seeing on the daily chart. Notice that from Tuesday crossing over to Wednesday's opening range gap, it was still being respected on Thursday. Look at that. Look at the respect of it here. Look at this candle's high. Look at the bodies in here. See that? So there's a whole lot more going on behind the scenes that is algorithmic, that unless you know about it, it's you're completely oblivious to it. The average trader, the average person that understands gaps, they don't think about the market like this. And that's what separates me from everybody else. If you want to be an apex predator, you have to hunt differently. You have to be the first one to take the prey. You can't wait around. This is not the second mouse gets the cheese. Okay, we're not mice. We're lions. We're going out and we're taking it. So the buy side is what I told you we would reach out for yesterday, right up above here, and that we would trade up into the high end of that gap. Okay. Yesterday we were talking. It was right about in here, and then we opened up here, traded down at 6 o'clock, and then we meandered around and then found our way up to it and above it, fell short of the buy side liquidity here. So the objective is what? Still run no stops. So it comes all the way back down to the low of that opening range gap from Tuesday and Wednesday. Now, I'm sure you're probably scratching your head if this is the first time you watch the video. What am I saying a Tuesday to Wednesday opening range gap is? Where do I get that information from, right? You have to change your chart to regular trading hours, not electronic trading hours. And you'll see the separation between the settlement price and the opening price on the new day. So this is what happened on Tuesday, and we have one here also. Okay, so I'm going to add this one. I'm going to change this one to a different color. It'll still be on the chart because it's very important you understand what's about to happen here. It's shaded in gray, so it's there like a ghost behind the scenes. No pun intended. The ghost in the machine. So we have the opening range gap for Wednesday, Thursday now, which is this now broader range. So there's an overlapping of those two opening range gaps. I promise you, you will never see that in books anywhere. Now, there's going to be people out there that hurry up and run out there and print their books on Amazon and talk about this because I've said it today. But this is the first time I've ever taught this. Even my charter members don't know this. So today, the 25th of May, 2023, I'm teaching you something that I've never given to the public before. So I want you to appreciate this. If you run around on your YouTube channel and create these mentorships of your own, okay, and you pretend that you knew this beforehand or have you always been doing it, you're going to look a little foolish now. So after we get this opening range gap here, the old one, Tuesday, Wednesday, we open above it, trade down, and find support at the lows of it. You see that? But it didn't fill this. Why? Why didn't it fill that? Because it has unfinished business. Where's that unfinished business? The buy stops up here. Ran up there, hit it. Now we have a gap. Just like we were treating yesterday's Tuesday, Wednesday opening gap, we had some portion still to fill in. Now we can look for this area here to potentially have a event fill it in tomorrow or reprice to it. And that's my expectation going forward. I probably am wrong. Okay, so don't put too much weight or emphasis on it, but that's how I would look at it. We're going into a holiday weekend. Anything can happen. So I'm really not even doing a video tomorrow. I'm not going to be looking at the market tomorrow. We're going to be doing something for our family. So I could care less what the market does. But if you're going to hold a gun to my head and say, ICT, tell me right now what you think, I think that we're going to try to make an attempt to get down here and work towards this area here. That's what I think. Okay, if I'm wrong, it would need to go back above current new week opening gap high for me to be bullish again. There you go. So now we have both of those gaps. We have Tuesday, Wednesday opening range gap, and we have the Wednesday, Thursday opening range gap. And we're back down here on electronic trading hours. So you can see there's relative equal highs. I said there was buy side last night. Go watch the video. That's where I think it's going to draw to and get to the top of that old Tuesday, Wednesday opening range gap. Well, we did that here. Then we fell short. Notice what we did. We went above the range high there, but we didn't get to the buy side yet. Then it dropped all the way down to the low of that gap. See it? Follow it along. You still see it in here, and then boom, it's gathering all kinds of new orders, but not by itself. Look closer. What is this? It's a fair value gap at the lows. So smart money is accumulating right in here. Market rallies up, comes back down, one more tap, and then takes off, trades into a buy side imbalance, sell side inefficiency, which is a fair value gap, and order block right there. Where's the target? The buy side I told you last night. Wham! Hits it beautifully. Does it continuously keep going higher? No. It rejects it, comes back down into the range, buy side, rallies one more time, pumps in, and then fails once more. So I'm watching to see if this potential phantom trend line here breaks. And if it does, we'll be looking for the sell side here, below here, and into the gap that would be otherwise expected to normally fill. But again, it's a holiday weekend. Anything can happen, folks. The volume will be different than it normally is. There's a lot of people that simply are going to go away. They're not going to be trading. They're not going to be doing anything. So bear that in mind tomorrow. All right, so now we're on that 5-minute chart, and we're ringing in the new day opening gap. Good grief, ICT. How many gaps are you going to talk about? All the ones that matter. Okay, so the new day opening gap, and I taught this on the YouTube channel, so take a look at that. You'll find it in the video playlists for the 2023 mentorship. New day opening gap, NDOG, NDOG. So we have the closing price at 5 o'clock, and then we have the opening price at 6 o'clock. So that hour separation is what we're showing here. That's your Wednesday, Thursday, new day opening gap. Extend that throughout the day. You can see how we get consequent encroachment of it here and then sells off. Consequent encroachment is half of any inefficiency or gap. Mean threshold is half of any order block. There's a distinction there. It's very important to keep that distinction and understand it. Then we fall just short of hitting the top of it here. We work outside of it and then rally one more time. Notice that in this little area right here, we're hitting an order block, but we're also in consequent encroachment of the low and the high. Remember that gray shaded? That's the Tuesday, Wednesday opening range gap. That range here, split that in half. That's consequent encroachment. That's what you're seeing right there. Order block, consequent encroachment of Tuesday, Wednesday opening range gap. Rallies. Yes, I'm going to have a specific tutorial video for opening range gaps. But I have to teach it. I have to prove to you a conceptual idea. I've done this in my live streams. I've talked about it also in analysis. But I'm giving you the foundation. And then when I give you a lecture, it'll be like, oh, he's pulled all those loose ends together. Now I can see what he's talked about now. But that's consequent encroachment of that. It rallies. Small little gap in here. Trades down into the low end of the new day opening gap for Wednesday, Thursday. That's this one over here. And you can see real quickly, unless you have these things on your chart, or as I have them written down. I look at the chart and I have these levels in my notes. And you're probably wondering, like, can you show us your notes? It's just simply these prices. That's all it is. And labeled what it is. It's not going to mean anything to you. But I've been doing this a very long time. So I know the levels I'm looking for, and I'm looking at it in terms of time. So what's so specific about this here and this here? It's occurring around that 8:30 news embargo. So we had news that come out, and then we have the impulsive price leg that runs up, retracement, runs again, it falls short of our objective, then crashes all the way back down into an order block here, and it's also the low of what? That Tuesday, Wednesday opening range gap low. And that shaded area here. See it? It's lining up right with that order block, digging into it, and then rallies one more time, and then finally blows out the buy side that I told you last night would be the objective for today's trading for Thursday, May 25th, 2023 for ES. We slipped lower, consequent encroachment of new day opening gap. That's this gray area. Rally one more time to run into the rejection block, which is the highest up close candle here. And I know some of you are like, man, this is way too much information. You don't need all this. This is just 30 years of experience in my models. These are my tools. These are my concepts. All right, so we have the 10 o'clock to 11 o'clock silver bullet hour in the AM session. This is ES on a 1 minute chart. And you can see at the high end of that old opening range gap, we're opening and then slamming down. Remember, we fell short of the buy side liquidity I told you we were going to go for. So we went outside the range of the opening range gap. And then right here, we slam lower, trade down into an order block. Remember the order block I showed you before we went into the slide here? Let me go back up. That's this one here, okay? The blue line is that order block right there on a 5 minute chart. On a 1 minute chart, that level right in here, what we're studying is the 10 o'clock to 11 o'clock time. I'm going to move it one more time, go back up to that. 10 o'clock to 11 o'clock, we're looking at this price action here. What's being shown on the 5 minute chart here, we're zooming into all this little area here on a 1 minute chart right here. Now all this, we're going to magnify it and looking at it on a 1 minute chart. So we're in that same area here. So the market drops down. We create a fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency. That's this move here. We create relative equal highs and relative equal lows. It trades down. Remember that shaded area here? This is the low of the old opening range gap, Tuesday to Wednesday, and Tuesday to Wednesday's opening range gap high. We're trading at the low of that old Tuesday, Wednesday opening range gap. Hitting it here, hitting it here. Look at the bodies respecting it. We just go outside of here, and then we run these relative equal lows there. The wicks are doing all the damage. Then we quickly run back up, take out a short-term high. Oh, now we have something right. This is the 2022 model that I taught on the YouTube channel. Take stops, shift in market structure, fair value gap, buy it. That's your silver bullet. Ooh, so I can blend the 2022 model and the idea of the ICT Silver Bullet, blend it together, and this is what you do. It isn't always going to be a continuation. You're going to treat it sometimes with a reversal, and this is what you're looking for here. You can buy it here. These arrows are just for illustrative purposes. These are not executions for disclosure's sake. I'm just showing you where your entry would be. This is how you want to do your own journaling. You want to, like in areas over here, or over here, or up in here, you want to annotate and reward yourself with positive self-talk, saying, it was amazing to see this pan out the way I was expecting it to, and you see this. And then when you look at it week end later, or the week later, or a month ago, you go back and look at your old stuff, and you'll read that, and your subconscious remembers that as pseudo experience. And the way you condition yourself with positive self-talk, never putting anything negative in your journal entries, you're conditioning yourself to see the positive aspects of these types of things in price action. And you trick your brain into seeing it like you actually did it. And by doing that, it helps fuel your motivation, and it removes the uncertainty because you're training your expectation and your understanding and your subconscious to recognize these things quicker by doing it. Versus if you just watched price action and leaned on somebody else to point things out to you. When you're backtesting and you're studying and you're journaling, you want to really put some work into this. You really want to do, this right here is better than most technical books. I have books that I spent $400 on, and they are not this annotated. They're not that detailed. I took my 30 years experience and what I look for in price action, and I applied it to this. These types of charts or examples of fractals and price action, this is what you want to treat this like meditation. And the more you put into this, the better you're going to be as a technician. And that technician will make you the better trader than you've ever imagined. But you have to do this step, folks. You can't just skip over it. There's no way you can learn how to do this without doing the backtesting and journaling and studying. It has to be done. And if you don't want to do it, then just simply expect that you're going to fail. Okay, and that's the honest truth, and there's no sugarcoating it here. I don't ever do that here. But if you're trying to do it half-assed and trying to do it and not really putting an effort into doing it right, you're not going to be successful, and you have nobody to blame but yourself. But there's two opportunities here for the Silver Bullet. You have this one here where it trades down into it, and then we have this one here, and it rallies up, takes the buy side here, and then runs into the bearish order block, and it doesn't even need to trade outside of that old range on Wednesday, Thursday's opening range gap. So we have profitability and being incorrect. Remember, we're aiming for the buy side. Wait a minute. You just said we're wrong and we can be profitable? Yes. Remember the rules for Silver Bullet. For ES or index futures, it's got to offer at least a 10 handle range. Well, if you're buying it down here at 41.42 and you're expecting it to go up to the buy side, that's the best case scenario. But you also have these gaps in here, this shaded area one here, and you have this one here. So you have Tuesday, Wednesday, and then Wednesday, Thursday's opening range gap. The algorithm will refer back to those same levels, folks. Okay, it's not just doing it today and yesterday. It's going to do this in perpetuity. Every day in the future, it's going to remember these levels up to 3 days. Sometimes it'll refer to it beyond 3 days, but if you use 3 days as a general rule of thumb, it will serve you well. After 3 days, take it off your chart. You do not have all these on the same chart. You have to create templates, and templates are useful. So you have a template that has all of the opening range gaps. So that way you're toggling. This is what I'm talking about. When I'm telling you that I have 12 different monitors and I'm constantly referring to everything and cycling through everything, I'm looking at that the whole time I'm talking to you. When I was doing those live sessions and calling the market live, when I'm doing it with Twitter and I'm saying this is what you're looking for, this is what you're looking for there, I'm constantly getting information and intel referring to these levels while prices marching along and ticking away. I'm not reacting to price. I'm anticipating it. And you, as a student of mine, you're going to learn how to anticipate too. You're not reacting to price. Retail traders react. You're essentially a breakout artist. That means you hope something happens, and when it does, then you can react to it. No, we're anticipating specific things to occur, and when it does, we're already there. We're meeting price right when it does whatever we're looking for. We're buying when it's going down, and we're selling when it's going up. That is completely diametrically opposed to retail-minded traders. And that's not to, be condescending to anyone that trades with retail logic. It just means that there's a huge chasm separating what it is I'm teaching you to do and how to interpret price action against everything else out there. It's light years beyond everything else, because this is the market. This is exactly what the market's doing every single day, and this is why I'm accurate. This is why you see me call it beforehand, and it happens, and my students have learned from me, and they're doing it too. You see them out there doing well. They're not making 9-to-5 type income. They're making 6-figure plus. And if you want to learn how to read price action, my way of doing it, it's going to take a lot of effort, and you got to be easy. But the rules were it has to be at least 10 handles or 10 points. Points or handles in futures is the same thing. I'm an old guy. I've been around for a while, and when we talked about futures or S&P, every full handle move or full 1 point move, which is 4 ticks, we always called them handles. And it's interchangeably used sometimes depending on who I'm talking to. If I just been asked recently by someone, what's a handle? What does that mean? It just means it's a full point move or 4 ticks. But the criteria for a high probability trade in ICT Silver Bullet is in futures, it requires at least the potential to see a 10 handle run. Well, if we're trying to buy it down here and we're using this as the best case scenario, if we're trying to get filled there, all it needs to do is print 41.47 even, and the spread would fill you. So you could be long at 41.47 and a quarter. If it goes up 10 handles, where's 10 handles? That's 41.57 and a quarter. That would be right here. And we're not even outside the opening range gap. We're just seeing it at the high of the new day opening gap. So it definitely is a high probability trade to be going long here, because it offers opportunity to even get 10 points or handles before it even gets up to here, which is where we're trying to get to. So we can find profitability by taking buy side liquidity, taking a partial, entering here, taking a partial here. You can pyramid here. So you can go in, like, say, for instance, if you use like my model, go in with 6 contracts. I'm not suggesting that you should trade with 6 contracts, by the way, but if you're trying to pyramid, okay, or if you want a pillar. Pillar is like buying 1 contract, buying 1 more contract, selling 1 here, holding on, and then selling your last one, and then stop out because you would be trailing your stop loss. Stop loss would probably be right below this swing low once it got up into this area here, because if it's going to reverse, it's going to reverse there, but you don't want to just collapse it because it could have very easily ran up in here at the buy side, but it didn't do it. It came all the way back down into the low of that order block once more. Route again right to the high of that old Tuesday, Wednesday opening range gap. That's that shaded area here. See it? It's a ghost image. And it drops back down to the low of the new day opening gap. And then consequent encroachment of the opening range gap of Tuesday, Wednesday. Here's the high of it, that shaded area, and this is the low of it. Trading down to midpoint of it, and then accumulate more, sending up to the high of new day opening gap Wednesday, Thursday. That's this orange shaded area. And then moving into the afternoon. This is a 15-second chart of what I just showed on the opening range and new day opening gap and the silver bullet between 10 and 11. I read a guy, he left a comment on someone else's video. I'll just kind of paraphrase it, saying the thing that's wrong, or the thing that's not cool about ICT is it's complicated, and I'm the only one that can use it. And I pull out silver bullets over here, over there, and it's like a WTF comment. He feels overwhelmed. Okay, and I don't know if it was just a guy that was genuinely sincere, just saying I'm frustrated and I want to do it, but it's just too hard, or if it's someone that's being a typical troll and whatever. But if you have that same mindset, okay, I strip price down below a 1-minute chart. I've said this. I talked about this in the Twitter Spaces before I actually did the Silver Bullet teaching. I taught Silver Bullet in a Twitter Space, which is like a podcast. Vocally, just talked about what it is and how it looks and where it forms. Then I taught the lesson, the lecture. That's just an introduction. There's a lot more to it, and I'll build on that as we go throughout the year. And I'm doing it actually here. But what time frame do you look for? Where's it form? It's a fair value gap that forms in between 10 o'clock and 11. It trades into a fair value gap. It does not need to be a fair value gap that forms between 10 o'clock and 11 o'clock. It could be a fair value gap that was prior to 10 o'clock. The entry is occurring in that window of 10 a.m. New York local time to 11 o'clock New York local time. Everything that I showed on the 1-minute chart, let me go back up and show you this again. Look right here. This is a 1-minute chart of the silver bullet here, and this is the silver bullet here on a 1-minute chart. Okay, a lot of overlapping in here, and then finally it leaves the range and it creates this fair value gap, and then it trades down into it and then it runs away. Let's go into this information a little bit more detailed, and also I want to look at all this imbalance here. Okay, why is it going up to here and stopping? Look right here. Here's your order block here. It went past that, beyond it. What's occurring in here? What is all that about? This is institutional order flow. You're not going to see it on a volume profile analysis. You're not going to see it on a depth of market. You're not going to see it on a ladder. You're not going to see it on level 2 data. All these things that you think makes you institutionally minded, it doesn't. It does not. All that stuff can be spoofed. What I'm going to show you here is how it never surprises me. It never jumps off the chart and says, oh, I got you, ICT. You didn't see that coming, did you? So think about what I'm showing you here. Study this for a second. Pause the video. Okay, really pause the video. Study everything you see here and all this movement down and where these silver bullet entries are occurring and where price reaches up here. It doesn't look obvious here, but when you drop down to a 15-second chart, which I'm about to do now, so if you're not ready and you're still looking at it, don't play it. Keep it paused. If some of you never pause the video, you're missing out on an opportunity to learn, but back to that 15-second chart. Here's that sell side imbalance, buy side inefficiency. Okay. All this run down here and then into this low, we create those relative equal lows. We go down below it shallowly. That little shallow run tells me that any retracement higher is just going to be one more drive lower. And what does it do? It runs right back up to some random level, right? No. That fair value gap right there. See that? It's also a mitigation block, which is this down close candle. High, low, lower high. It's a reversal of sorts on my breaker pattern. So typically a breaker would be a high, low, higher high. A mitigation block is the down close candle in between the high and lower high. So it's trading up into that there and in an imbalance there. And then drives harder. So that's taking out the sell stops here. So it engineered it. It went low, low, created retail-minded support. They're going to buy it. It rallies up. They feel rewarded, and then it comes back down. They may or may not have been stopped. It doesn't matter. Now, if they didn't have a stop, they're really going to put a stop loss there, right below those lows, in that low, in that low. And then you see it go wham. Spends time down there trapping traders. Then it rallies. Takes out a short-term high. That's a shift in market structure. Creates a fair value gap on the 1 minute chart, but look closer now. This is a 15-second chart. ICT, come on, bro. Seriously? Like, I'm not looking at 15-second charts. Okay, then this lesson isn't for you. I've already taught you how to trade using the model 2022. You don't need this. You don't need this to make my stuff work. But if you want to be a freak, okay, if you want to be a freak in technical analysis, no, slash that. If you want to be a freak in technical science, because that's what I teach, okay, we do technical science here. It's not contrived, it's not conjecture, it's not guesswork. We have this down to the smallest degree and the highest degree of precision. Look closer. Inside of that shaded area on a 1 minute chart is a fair value gap, but you don't see that as a fair value gap here on a 15-second chart. In my charts, in my monitors, I have one monitor that I use and I dub it as a intraday matrix where I'm toggling through constantly. Just by a couple keystrokes, I'm going through 5 minute, 4 minute, 3 minute, 2 minute, 1 minute, 45 second, 30 second, 15 second, 5 second. I'm looking at charts just like that as I'm looking at key levels. So when we're in this institutional area here where orders would be resting, what kind of orders? Sell side liquidity. Then it rallies up and we have a shift in market structure. Wonderful, because I'm expecting that buy side liquidity, which is outside the scope of this chart here. Remember, it's above. That's where I think it's going to go. I told you that last night. This 1 minute imbalance here that's shaded, it doesn't look like a fair value gap here. But what is overlapping on a 15-second chart that's still useful using what my PD array matrix taught you in the core content on my YouTube channel? 2 down closed candles is a bullish order block. Extend that to the right. We're digging down into that order block there, rallying and coming back down into it again. There's an order block and a fair value gap. That right there, if I didn't buy it on this pass here, I would see that and be going long. And I would buy it again here and adding more to it in pyramid. That's why you see me sometimes entering, and it's like, why is he buying it? Like if I'm going long, for instance, I'll do executions and I'm recording it. I'll go long, buy it, and then a couple seconds later, I'm buying it again. And it's like, what is he doing? It's this. I'm buying it here. I'm buying it again, and I'm adding it here. So it's like 6 contracts long, 4 contracts long, 1 contract. Or I'm sorry, 6 contracts, 3, and then 1. That's my 10 contracts. So it's 6, half of that's 3, and then there's no half of 3 that I can do. It's 1 contract. So that's my standard 10 lot model where I build in. If I think the trade's good, I'll do that. Well, if I don't see the lower time frames doing this, I'm not going to do those real close proximity entries where I'm showing you multiple entries generally in the same area. I'm dialing in with a very small sub 1 minute contract basis, and it looks just like this, but you're not seeing it because you don't have a 15-second chart or less than 1 minute. TradingView offers that. I don't know what program or package you have to get that, but I'm the highest level membership there. So I think it's like $600 a year. But if they do the same thing they did last year on Black Friday, you can get it really cheaper than that. But if you don't want to spend $600 to have this kind of information, or you can't get it somewhere else and you don't want to pay for the data, forget trading. Because if you don't want to invest in the tools to be able to do these types of things to this degree of precision, you're probably not going to do well. Okay, there's no free way in this. Okay, I may be teaching for free, but it's still going to cost you something. It's going to cost you time, which is very expensive. It's going to cost you money in resources and some kind of platform. And if you want to have the degree of precision that I teach and make available to everyone with my teachings and lectures, this is one of those things you're going to have to reach into. You can't just simply look at just a 1 minute chart and think you got everything that I've taught, because I'm below a 1 minute chart on everything I trade, everything. And I'm looking at these types of things here. Same thing here with that silver bullet up here. This range is a 1 minute fair value gap. You can't see a fair value gap in here. You see this down close candle though, don't you? So when it's trading down into that, that's where I'm going long. I'd be buying that order block right there. And then as it was dropping down, if it would have hit that again, that shaded area right on here, on the 15-second chart, I would add to it there. And the market runs up. Look a little bit closer now. Look at this inefficiency. All of this movement down here, there's pockets where there is only one candle passing through. We have this small one in here. We have a small one right in here. All of this here, one candle passed through, one candle passed through here, and right in here. This one here is essentially repriced to right there. And it's rebalanced because it's left it here, here. So this was of no interest to me. This one gets filled in and repriced and balanced because it's back and forth inside of this area here. So now that's balanced. If we rally above that high, then we should have no problem going higher and not ever need to go back below that high. What I just said is huge, because everything over here is telling you the narrative that needs to be displayed in price delivery. Once we have this back and forth movement, that means it's efficiently been balanced. Once it leaves it, that means goes above it right there. It never needs to go back below this high. Does it? Not until it goes above and rebalances into this area here. This range here is this price formation. It reaches up into that, then pulls back lower. This range in here, it trades up into it here, finds support at it, and then rallies above. It does not need to go back below this high. It's acting as support, rallies up. Again, as I taught last night, if you want to understand what classic support resistance is and what it means for you to look at it in charts, and you don't want to be this in depth, you don't want to be a technical science major, you want to see simple trading, then you look at these inefficiencies around levels you would expect as support resistance. And if you see the things I'm teaching you here, you'll probably be safe in trusting that as a support or resistance. Doesn't mean you're going to be 100% accurate. It just means that if you're trading with support and resistance ideas, if these inefficiencies that are to the left of the chart are balanced, not just repriced to, when they're balanced, that means up and down price delivery, and then it leaves that range. Then it becomes a real balanced price range, and then you can trust that it won't go back through it. It'll act as either support if it's going higher or resistance if it's going lower. You can see that area here. They work this level here back and forth. It's balanced once it leaves it. So then all I need to do is see it trade above it. That high right there gets traded above it, comes down, never sees it again until we get to this area here where this is inefficient and it's been rebalanced. This candle here trades down, then it opens, trades down, up, and leaves. That range is the only exposure for inefficiency, because this candle went up, this candle went down, this candle opened, went higher, and then back down. So this range here and higher to that high it's balanced. The inefficiency is this candle right there. So that's why it only went right up to the tick. 2 candles and then plummeted down to new day opening gap low, and then down into, which is a little bit to the left, I'm sorry, to the right of this. It's not in the scope of this fractal being shown, but it's the consequent encroachment of the Tuesday, Wednesday opening range gap.